What's up, everyone? It's Caddy with MoneyVest. So in this video, we are going to be talking about tomorrow's upcoming unemployment report. I'm also going to break down some of the reports that came out on the bond market, which obviously, as we know, continues to push higher. We're seeing one of the biggest sell-offs in the bond market with so many leverage shorts, with so much imbalance from a government fiscal standpoint. So we're going to talk a little bit about that as well, and also go over what the forecast is for tomorrow's unemployment report. I will be live actually to cover that report with you guys at around 8:15 a.m. Eastern, and then also break down how the markets might react to the report that comes out, right? Whether that's going to be bullish, bearish, neutral. So I'm going to prepare you guys for tomorrow. Even though I'm not one for making predictions, we'll try to understand what numbers can result in what type of reactions from the market. So hope you guys enjoy this video and find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Again, links to our Discord and Patreon is going to be down below. Would love to have you on board, and of course get access to all the Excel spreadsheets, the MoneyVest stock reports that are going to be included starting this weekend. Members only private videos. There's over 42 videos that I've already posted for all the members, and of course Discord channels and over 20 private channels, including alerts as well. So links are going to be down below. We'd love to have you on board. So first things first, the U.S. jobs report forecast is about 170,000 new workers and an unemployment rate of 3.7%. So the forecast is about 170,000. So that's going to be that number right there. That's the number of jobs we're expected to add in the month of September, keeping the increase below 200,000 for the fourth month in a row. And the last time that happened was in 2018. And even those small increases, however, have been enough to soak up all the new people entering the labor market each month. And Federal Reserve officials believe that the economy needs no more than 75 to 100,000 jobs, right? So if you're seeing more than that, 170,000, that basically continues to suggest that we are seeing significant amount of labor shortages, and that's going to increase the wages back higher, because right now, of course, we know there is a supply and demand imbalance. There's more job openings than available workers, and as a result, workers are able to negotiate better when it comes to wages, which obviously is going to be very, very difficult for the Federal Reserve to get inflation under control. So that's where we are. 170,000 is going to be that number for tomorrow. Now, unemployment rate, however, is also expected to decline to 3.7%. So from 3.8 down to 3.7, that's going to be that number that it's expected to come down to. Now, I'll go over what that means from a technical standpoint, right? So from a spreadsheet standpoint, so we've already been talking about this. We got the JOLTS numbers earlier this week, which was at 9.61 million. We have already mentioned that in one of my previous videos. Jobless claims came out at, once again, at a little bit over 210,000, I think was that number. Let me just quickly go over exactly where we are. So right here, initial claims 207,000. So we can plug that number in over here. So 207. And unemployed persons, as of the most recent report, which was the last unemployment report, was a 6.36 million. And this is really where the focus needs to be, right? Because if you come down, you'll notice total jobs added. We're going to edit this number. We're going to edit this number, and you're going to see how things change, right? So this right here should really be the same as over here. And total employed persons, that's perfect. So total jobs added, we're going to plug about 0.17 because that's 170,000. And you'll notice the new total employed goes up, right? It's simply total employed persons plus the amount of jobs added. And that obviously lowers the participation rate. So 0.17 is going to put it down to 62.7% here. Just want to make sure that that is indeed correct, because we're looking at this participating population divided by this right here should be total eligible workers. Okay, so that's good. So participation population here should be this total new employed. Yep. So this right here is what I need to update. So that's going to be 6.366 minus whatever amount of jobs we add, right? 0.17. So we're going to plug that in. No, that doesn't sound right. Okay, let's just do this. Minus right here, this. Okay, there we go. There we go. Now it's perfect. So now the new total unemployed will come down to under 6.2, right? And from earlier, it would be 6.36 to 6.19, which will obviously lower the unemployment rate, right? So you can see that it's going from 3.8 to 3.7. Right? Once again, it's going from 3.8 to 3.7. That's exactly where the forecast is coming in. That we are seeing, okay, jobs added 170,000. That's going to decrease that new total unemployed number down to 6.19. And if that happens, look what happens to the ratio. We jump to 1.55, right? That's going to be that JOLTS to unemployed persons ratio to 1.55. And this is obviously not going to be great news because this continues to suggest what? That the economy is strong, the labor market's tight. We've got lots of jobs, 1.5 jobs to be precise per unemployed person. And that continues to pave the way for the Federal Reserve to keep doing what? Be restrictive, continue to do quantitative tightening, and potentially even raise interest rates one more time. So what we want to see is, even if there are job gains, even if there's total jobs being added, we want to see more and more new total unemployed persons to go up. And the only way that's going to happen if the participating population either goes up or we start to see jobs not being added as many as 1.17, right? So if you see, let's say, 0.05, for example, right, then that unemployment rate starts to tick higher and higher, and that's going to increase the new total unemployed persons. And of course, if there's more people getting laid off, if that number starts to get into the negative territory, like for example, -1, right, that's when the unemployment rate, you can see that it jumps up to 4.4 because the new total unemployed persons now at 7.36 million. So hopefully this is making sense for all of you because it's all, tied back to the jobs added. It's tied back to the total unemployed persons, and that's really what's controlling the overall unemployment rate relative to the participating population. So that's where we are. I mean, if the forecast is correct, that ratio will go up to 1.55, which will once again suggest a stronger economy. And it's possible the markets do not like that very much, and we start to sell right back down. And right now we are seeing the NASDAQ down about 73 basis points. The S&P is coming down to its 200 simple moving average, coming down to 42.44, down about 0.5%. But tomorrow, again, this is going to be very, very important. First Friday of the month, I'll be live to cover this unemployment report. Now, there's a few more things that I want to go over, which is with more regards to the 10-year yields. And this was a analyst named Kupperman, and he basically says, and I quote, the bottom can't be in while the 10-year treasury bonds are still inverted relative to the shorter term bonds. And he said there's no reason why the yield can get to 6%. And a median area for the last 50 years has been 6%, and then probably overshoot that. And what he basically said was absolutely mind-blowing. He says, and I quote, I wouldn't be surprised if you go back to the teens. To the teens. 13, 14, 15. Like, that would be insane. That would just be catastrophic for the market, which he sees happening over time unless a government has some fiscal sanity, is what he mentioned, of course, because we know there's a lot of fiscal deficits. The mountain of debt continues to go up, and as a result, there's higher interest rates on that. And look, with higher interest rates, this actually is going to potentially put everybody in the fiscal policy in line and probably get them more disciplined because interest rate alone on that debt is going to be huge. And he says, think how ridiculous it is that we are running an effective 8% nominal GDP, 8% deficits in the boom, and probably like teens in the next recession. Payroll tax was up 9% year over year for the third quarter. So the economy is really strong. So how is it the 10-year yield at 4% and some change? It makes no sense. It should really be at a 6% handle. And I think the reason why it's not at 6%, it's closer to 4%, is because even at these levels, we haven't seen the yield as high as it is in over 16 years. So there's a lot of investors, a lot of pension funds, a lot of capital allocators like the whales. They are very interested in, allocating some funds to the 10-year yield because they're locked in at 4.7, 4.8, right? So there's a lot of demand that's now starting to come in because they haven't seen these levels in over 16 years, right? So I mentioned in one of my previous videos that think of it as if you're a bond trader, right? If you're a bond trader, you've been a bond trader your entire life, you haven't seen these yields in over 16 years, right? You haven't seen these types of numbers on the 10-year, on the 20, on the 30-year handles in over 16, 20 years. So of course, there's going to be demand coming in. Of course, there's appetite for the market to absorb the issuances, the auctions that we're doing. That's why we haven't quite seen 6% level yet. But once it starts to get absorbed, and there is a possibility that this fiscal deficit and the amount of debt continues to increase, we could get up to 5% or 5.5% or closer to 6%. That is a possibility. So that's something that we need to be prepared for. That's exactly why I've been a little bit more patient and slow and steady in dollar cost averaging into TLT or TMF or things like that, bond ETFs. And of course, the market's divergences continues to be there from a technical standpoint, and of course from a macro perspective as well. So that's where we are. Tomorrow's unemployment number is going to be very important. We'll be live to cover that report. Make sure that you drop a like, of course, subscribe to the channel here. 75,000, we finally did it. Now next target is going to be 100,000, and I really appreciate each and every one of you guys. It's been a long and a very, very tough journey to getting up to these levels. But of course, the next target is going to be 100K. So thank you so much for joining. I appreciate you all. As always, happy investing. Links are going to be down below. Happy investing. I'll see you all in the next video.